On November 5th, 2025, a palpable tension gripped the trading floors and digital screens alike, where the once unstoppable ascent of markets had given way to a swift and merciless unraveling. By midday, reports flooded in from every corner of the financial world. The cryptocurrency market had hemorrhaged a staggering $250 billion in capitalization within hours, a brutal evaporation that left Bitcoin teetering below the psychologically vital $100,000 mark for the first time since early summer. Ethereum, the backbone of decentralized finance, plunged over 10% to around $3,200, while altcoins like Solana and even meme-driven tokens such as Dogecoin and Bonk cratered by double digits, dragging the total crypto ecosystem into a vortex of red charts and frantic sell orders. Liquidations cascaded like dominoes, with over $1.73 billion in leverage positions wiped out across exchanges in the prior 24 hours alone. According to real-time data from platforms like CoinGlass, as overleveraged traders, many betting big on the post-election euphoria, found their stops triggered in a frenzy that amplified the descent. This wasn't a gentle correction. It was a visceral purge, echoing the sharp drops of past cycles, but fueled by a uniquely modern cocktail of factors that had been simmering for weeks. The spark for crypto's implosion traced back to a confluence of macroeconomic tremors and internal market fragilities that had been building since late October. Bitcoin, which had surged past $107,000 just days earlier on whispers of institutional inflows and regulatory tailwinds from the newly seated administration, suddenly faced a sentiment flush, a rapid evaporation of confidence that analysts at CryptoQuant likened to a pressure valve releasing pent-up froth rather than a structural collapse. High borrowing costs played a starring role. Even after the Federal Reserve's recent rate cut, yields on short-term treasuries hovered stubbornly above 4%, making yield-bearing assets like bonds far more seductive than the speculative allure of digital coins. Crypto, in essence, became the canary in the coal mine for risk aversion as investors rotated out of high-volatility plays amid fears that the Fed's dovish pivot might not hold against persistent inflation data trickling in from Europe and Asia. But the real accelerant was leverage. Exchanges like Binance and Bybit reported over $20 billion in open leverage positions, a record high that turned minor dips into avalanches. When Bitcoin breached that $107,000 support level overnight on November 4th, it unleashed a cascade of automated sells with long positions, bets on upward momentum, accounting for $1.32 billion of the liquidations. Whales, those shadowy institutional holders, exacerbated the pain by offloading approximately 400,000 bitcoins over the past month, equivalent to $45 billion at peak prices, as reported by Bloomberg, likely in response to overextended portfolios and profit-taking ahead of year-end tax considerations. Yet this crypto carnage didn't unfold in isolation. It was inextricably linked to the broader equity meltdown that saw $730 billion vanish from the U.S. stock market's total valuation in a single session. A figure that, while dwarfing the crypto wipeout in absolute terms, represented a mere 1.2% dent in the behemoth $58 trillion ecosystem. The S&P 500, that barometer of American corporate health, shed 80 points to close at 6,771, a 1.17% retreat that masked deeper wounds in the tech sector, where the Nasdaq tumbled over 1.4%. The Dow Jones, ever the steadier blue-chip sentinel, fared slightly better with a 0.53% dip to 47,085, but even it couldn't escape the gravitational pull of the sell-off. Tech titans bore the brunt. Palantir plummeted 8% despite beating earnings estimates, a classic bubble top signal where guidance failed to justify sky-high valuations. AMD and Arista Networks each dropped 12% post-earnings, as investors questioned the sustainability of AI-driven growth amid softening demand forecasts. Nvidia, the poster child of the AI boom, wobbled as well, its shares slipping amid whispers from short seller Michael Burry, who had quietly amassed a $1.1 billion bet against it and Palantir just weeks prior. This wasn't random volatility. It was the market's collective exhale after months of frothy exuberance, where forward price-to-earnings ratios on the S&P had ballooned to 25 times, levels unseen since the dot-com mania of 2000. At the heart of the stock plunge lay an AI bubble that had inflated beyond reason, punctured by a chorus of warnings from the very guardians of finance. Jamie Dimon of J.P. Morgan Chase, in a rare moment of unfiltered candor during a mid-morning earnings call, declared the AI hype real and cautioned that a serious correction loomed, his words rippling through trading desks like a shockwave. Goldman Sachs and Morgan Stanley echoed the sentiment in their quarterly outlooks, flagging overvalued equities and projecting a potential 10 to 20% drawdown in the coming months if earnings growth faltered. The irony was thick. Just days after the Federal Reserve's rate cut was meant to lubricate economic gears, fresh data revealed cracks widening beneath the surface. First quarter GDP had contracted by 2.2%, the steepest drop since the COVID nadir, while consumer confidence surveys hit 5-month lows, reflecting sticker shock from lingering supply chain snarls and tariff threats bubbling from the new administration's policy playbook. Job growth, once a resilient pillar, stalled as subprime lenders buckled under rising delinquencies, and the specter of a prolonged government shutdown, now in its 5th week, threatened to shave 0.5% off November's consumer spending. In this environment, AI wasn't a savior. It became a scapegoat, with investors reassessing whether the trillions poured into data centers and chip fabs could deliver returns before profitability timelines stretched into the 2030s. Global ripples amplified the pain. Asian markets like Seoul's Kospi dipped nearly 3% on similar AI bubble woes, and European bourses followed suit, creating a synchronized retreat that funneled capital back to perceived safe havens like gold and cash. The interplay between these twin implosions revealed a deeper truth about modern markets. Their hyperconnectivity turns isolated sparks into infernos. Crypto, often dismissed as the wild cousin of traditional finance, had increasingly mirrored equities in 2025, with Bitcoin ETFs pulling in billions from the same institutional pools, betting on Nvidia and Palantir. When tech valuations cracked, it triggered a risk-off exodus that hit digital assets hardest, given their thinner liquidity and higher beta, meaning they amplify broader market moves by 1.5 to 2 times. On November 5th, this linkage was stark. As Palantir's post-earnings tumble flashed across screens, Bitcoin's correlation coefficient with the Nasdaq spiked to 0.85, prompting algorithmic funds to dump crypto holdings in lockstep with equity portfolios. Regulatory shadows loomed large too, whispers of stricter oversight on AI energy consumption, given data centers' voracious appetite for power, fed into crypto's own environmental critiques, while tariff proposals from the White House threatened to hike costs for semiconductor imports, squeezing margins across both ecosystems. For retail traders, caught in the crossfire via apps like Robinhood and Coinbase, the day felt apocalyptic. Margin calls pinged relentlessly, with over 300,000 accounts liquidated in crypto alone, per exchange aggregates as panic selling intensified in a feedback loop of fear. Zooming out, this double-barreled drop wasn't merely a blip, but a reckoning for the asset bubbles that had defined the post-pandemic era. Since the November 2024 election, markets had ridden a wave of optimism, fueled by deregulation promises and AI evangelism, to record highs, only for reality to intrude with sobering precision. The crypto market, which had ballooned from $1.2 trillion at the year's start to $2.5 trillion by late October, shed 10% in a blink, underscoring its immaturity. A space where sentiment can swing on a tweet or a Fed dot plot, and where 70% of trading volume stems from derivatives rather than spot buys. Equities, for all their maturity, weren't immune. The $730 billion loss, while small in proportional terms, erased gains from the prior 2 weeks and left the S&P 30% above its 2024 lows, but perilously close to testing the 6,500 support that bears like Raoul Pal had long flagged as a gateway to deeper pain. Optimists, like Real Vision's Pal himself, framed it as a road to Valhalla, a necessary flush before the next leg up, with Bitcoin potentially rebounding to $120,000 by year-end if whale accumulation resumes. Pessimists, including perma-bears like Peter Schiff, saw omens of a total 2025 wipeout, predicting crypto's retreat to sub-$50,000 levels as over-leveraged dreams collide with fiscal tightening.